It is so important to have a portion of your money, especially going into retirement, that is completely independent of the market. So over the last few weeks, as of recording this, I've been interviewing a lot of different people. And one of the biggest financial concerns that keeps popping up is what happens when I go to retire and the market crashes. So the fear of the market crashing when they go into retirement, like a 2008, for example. And the biggest thing was, okay, I could do everything right. I saved, I invested diligently for my retirement. I have this nest egg that, you know, is good enough for me to retire on, but I happen to get the short end of the stick, and the year I go into retirement, the market takes a dump. And the second thing I'll say that was in line, or right behind that, was the fear of running out of money in retirement. So I'm gonna draw out this 4-tiered cake here, and I'm gonna break down everything there. So the first layer to this cake is guarantees. And after I draw this out, I'll break it down further. So the first layer to this cake is guarantees. The next layer up is your safe layer. The third layer from the top is going to be your moderate layer, moderate. And then the top of the cake is going to be high risk. So I draw this cake out here, and it's something I've just kind of came up with, because we have to first understand when it comes to market risk and eliminating worry about market risk, we have to first look and figure out, well, where is our money invested and how much risk are we actually taking there? So I'm actually going to start from the top and work our way down. So let me move this over a little bit. So in terms of high risk, some things that can go into this category here: cryptocurrency. And by the way, I'm not saying, when I go through this, I'm not saying to invest in anything or to not invest in anything, but first thing is crypto. Personally, I'm a fan of crypto. I'm invested in crypto, but let's be real, it's still fairly new in the grand scheme of things. It's very volatile. I mean, I don't know if you've looked at it the past year, it's down quite a bit, relatively speaking. And that's just something that, you know, until it's regulated and it's more stabilized, it's high risk. I mean, it's high risk, high reward. So cryptocurrency is definitely in that high risk category. Another thing would be I'll just put PE for private equity. So that's another category. It's like, it's probably one of the highest risk investments you can make out there. I mean, it's essentially, is it going to go public or it's not? I mean, and you don't have any control either. Amongst many of these things we're going to cover, you lack control. So private equity is a great way you could potentially make money, but there's also a lot of risk of it going to zero. Same with crypto. The last thing I'll put on here, and this could be pretty controversial, but I'll put business up here. So having your own business, like I have my own business, I think it's one of the greatest and most fulfilling things you can do, but there's a lot of risk that comes to it. And there's no guarantees with it. You know, your whole industry could change overnight, or something like COVID comes about and you're a gym and all the gyms get shut down, and now your revenue is sliced in half overnight and you got to figure out what to do. So there's tons of risk when it comes to business, but again, high risk, high reward. Moderate. So this is where, when we break this down, this is probably where you have most of your money. This is where most people have their money. So moderate would be things such as your 401k, your IRAs, your index funds, so like the S&P, we'll put S&P 500, mutual funds. So stock market is essentially what I'm getting at first. I would put real estate in here as well. Contrary to what you might see online, and especially if you're a real estate investor, you know it's not, like, there's risk to it. It's not this super safe thing. So that would be more of your moderate category. Like, it's not as high risk as crypto, private equity, business. You are taking quite a bit of risk, but there is more stability with it overall. Your safe this is more of your, part of it at least, is like your liquidity. So I'll break that down. So safe would be your checking savings account, checking savings. This would be your, you could even say gold and silver, I would put into this. Gold, silver. Let me put a little line here. Money market account would fall into that. Money market, yep. I'll put HYSA, so it's another savings vehicle, but a high yield savings account would fall into there, CDs, and then bonds. Those would all fall into what I would call your safe money. Like there's a very high likelihood you're not gonna lose money there other than maybe inflation. Gold, silver goes up and down, but that's generally a pretty safe spot to keep your money. Now the layer below it that most people don't have any money in is what I call guarantees, or the guaranteed layer. So what is that? What is that made up? There's really four main things. So this one we all get. Well, I don't know if I'll get it when I go to retire. I don't think it's going to be even a thing, but we got Social Security. You've got pension. So if you're lucky enough to have a pension, obviously that's guaranteed income that you're going to be receiving for the rest of your life. There's two other things I want to touch on here. You've got annuity, your annuities, and then you've got whole life insurance. A form of, I'll put CVLI, it's a form of cash value life insurance. So let me zoom back out here. So if we're looking at this cake here, actually let me zoom back in on the cake. If we're looking at this cake and the number one fear is, I'm worried that when I go to retire, the market's gonna drop. What do you think you need to do to eliminate that fear? Well, the biggest thing is look at where your money is at, and I can almost guarantee that most of your money is probably, if you can see that line there, it's probably in the top three layers. Well, what's the problem here? The problem is your foundation is pretty much non-existent. I mean, I wouldn't really count Social Security as a super strong foundation, especially if you've got 10, 20 years to retire, but it is a part to it and it's important. But the guaranteed layer of the cake, your foundation that should be absolutely unshakable, is pretty much non-existent. And that's where, I'm actually gonna erase the board here. Let me erase all this. That's where we need to build a plan and start to have the conversation around, okay, I've got way too much money that's in the market. And again, if you're someone who values peace of mind, and that's a common theme, if you've been watching my other videos, it's a common theme that's been popping up of people saying, I prefer peace of mind over market performance. I prefer peace of mind over chasing the highest return I can get. Let's say hypothetically, it's like, okay, you want more peace of mind, that's the goal. Well, you have, if we're looking at that cake, right? You've got, you know, the top three layers. That's not really a cake, that's more of a tower there. But if these top three layers here, that's where, you know, 100% of your money is invested or saving or safe, then obviously that's not going to be ideal going into retirement if you are fearful of what's going to happen with the markets. Now, what if you took, hypothetically, you shaved off 40% of that and put it to this bottom layer? So it's like you're building a building. It's like you need to have a very, very strong foundation. Like, what building can withstand anything, storms or the worst things, if there's not a strong foundation? We have to look at it the same way with our finances. Like, if all of our money is just in things we can't control, has volatility involved with it, well, obviously we're not going to be able to predict what's going to happen. So that's where we need to start having that conversation of like, why don't we rotate some of our money, especially if it's money you already have in other buckets, we can rotate some of it towards the bottom layer, towards the guarantees, and that way when the market dumps, so I'll go over here, if you had $1 million, let's say, invested, right, in the market, you go to retire and the market drops 20%, well, now you're down to 800,000. So now you're down to here, and you still have to take income. So when you're taking out income, let's say you're taking $40,000 out from here, now your 800 is dropped down to 760. So obviously going into retirement, if you wanted to, you're planning to take $1 million off or 40,000 off of $1 million, and you happen to get the short end of the stick, and the market dropped down 20%, and then you have to draw income out on top of that, well, that could completely derail your entire retirement plan. And that runs into the second fear that comes up of like, okay, I'm afraid of a market crash when I go to retire, but what happens if I run out of money during my retirement? So that's where this goes over to the next piece of the conversation, which will just focus on this guaranteed layer again. guaranteed. So with this guaranteed layer, if you can combine your Social Security, so Social Security, you're lucky enough to get a pension, you could put that in there as well. And let me make this a little bit bigger. Pension, and then also we layer in annuities, annuity and whole life insurance. And I'll break each one down. If we can get this bucket or this layer to completely equal our minimum, I'll put min lifestyle, then there's nothing to worry about. Okay, so this bottom layer, the guaranteed layer, if we can do whatever possible to make sure that we're having enough guaranteed income coming in to cover our base or minimum living expenses, then you have that peace of mind of, okay, if the market does crash when I go to retirement, that's okay. If these top, let me redraw it again, if these top 3 layers here of the cake, you know, they're not completely gone, but they take a dump, it's like, all right, cool, I have enough money to live and to do what I need to do from the guaranteed sources, which we'll break down. Now, what that allows you to do, instead of locking in losses during a market crash or while the market's down, you can let those market-based investments recover. Okay, so that's going to be not only from a peace of mind standpoint, but from a numbers standpoint. By not touching the market or your market-based investments while they're down, increases the likelihood that you're going to have enough money to last the rest of your retirement. Again, those are the 2 biggest fears. So when it comes to this guaranteed bucket of money, that's where we have to start asking ourselves, like, okay, where else do I have money that I would be okay with getting a less return on to give me more peace of mind, to bring more stability and certainty to my life, knowing that it's guaranteed? Hypothetically speaking, let's say, and there's actually one other thing I want to cover very briefly before I get into this. There's 2 parts to retirement planning. There is what's called, if you can see this arrow, this is called your accumulation phase. Accumulation. And then you've got the other arrow going the other way, which is your decumulation. Your accumulation phase, the way that you actually are building your nest egg and you're building up your portfolio, is completely different than the decumulation or the distribution phase of how you're actually going to draw income from that. That's the one thing, that's the whole point of building up the retirement portfolios, for income. Now, the strategy though to accumulate is not going to be the same. And that's one thing that people often don't rebalance or shift, is like, okay, I'm very heavy on equities during my building years when I'm earning a lot of money and I'm younger, I'm willing to take more risk. But when I get to 65 years old, it's like, okay, well, I built up all this money now, but now I'm kind of fearful. It's like, again, if I have 100%, 80%, the bulk of my money, my retirement, solely in the markets that can go up and down like that, it's like, well, there's a lot of variables that come into play of like, will I have enough money to retire, and will it last the rest of my retirement? It's like, if you happen to retire on a down year, like we talked about, that could be not good at all. So I wanted to just draw that out there before I tie into the building of your guaranteed layer. So we're just going to assume, I'm going to cross out the pension there. We're going to assume you don't have a pension, because most people don't. But your Social Security, your annuity, and your whole life, if you can get those 3 combined to equal your minimum expenses, you're going to be in a good spot. So I want to touch on these 2. So with an annuity, and there's lots of different ways to go about this. Again, if you already built up a nest egg of money with other investments, this could potentially be, and I emphasize potentially be, a good route to go. So with an annuity, the powerful thing with annuities is, in terms of funding it, is if you have other qualified accounts, you can actually roll over all of it or a portion of it over to an annuity. There's no taxes and penalties for doing that. So hypothetically speaking, if you had $300,000 in a traditional, not a Roth, a traditional IRA, and you're like, you know what, outside of the IRA, I have another $2 million in investable, or in investments and whatnot. Hypothetically, you could say, okay, you know what, I want to take $300,000 of my market-based portfolio and I want to roll it over to an annuity to grant myself some peace of mind to get some guaranteed income. Now, depending on your age, and there's many factors, that $300,000 going into the annuity, the insurance carrier might come out and say, hey, based on that $300,000, we're going to guarantee you 7% a year on that. So my math's a little off right now. 7% of 300,000 would be 21,000 a year, and that's pretty reasonable. Like a 7% payout factor, even 6% if you want to be a little bit more conservative, is pretty reasonable for an annuity. So you might roll over 300 and get a guaranteed income stream of 21,000, and then with your Social Security, you know, let's just say, just to keep it simplistic, let's say that was another 21,000. It's like you've got 42,000 right there, and then with the whole life insurance policy, I'll draw an arrow over here, that's another bucket of money where you can't roll over money directly into it, but if you over time added that into your portfolio, it's a guaranteed asset, so it's not correlated to the market. It's going to go up every single year regardless of what the markets are doing. But the money that you build up in cash value, that's something you have access to during your retirement. So going back to the whole premise of a down year, let's say your whole life policy had $30,000 in it for cash value. Well, if there's a down year and you need $50,000 to meet your minimum living expenses, instead of touching these other layers to the cake, you can come over to your guaranteed income streams and go, okay, I'm getting 42 here, 42,000 from my Social Security and my annuity. I have 30,000 in my cash value. You could borrow out another, let's say, $8,000. Now you're at your $50,000 of base, assuming that's what your base living expenses are. Like assuming your minimum expenses were $50,000. Now you know, and you have that peace of mind, like, okay, I have enough guaranteed income coming in to live, to do what I need to do. I don't have to touch the other layers of the cake. I don't have to touch my other market-based investments. I don't have to touch my safe money even. If I don't want to, my cash, my emergency fund, I don't have to touch any of that, but I can utilize these assets here to provide enough money to live comfortably and to have that peace of mind, like, okay, I'm going to have enough money, number one, to meet my minimum expenses without depleting my market-based investments while they're down. I can leave my emergency fund intact. And then on top of that, you know, with these guaranteed income streams, they last for life. So until you die, you're going to be getting this money every single month. So I hope you got value from today's video. It's something very important. More conversations need to be had around peace over performance in your finances, especially when you're going into retirement. It's like you don't need to chase the next biggest investment and get the highest rate of return. It's more like, how can I preserve what I have, still get growth? I'm not saying with any of this to do any of this, by the way. I'm not giving you advice. It's more, let's just ask these questions of like, okay, maybe I can shift from being so equity heavy to more conservative. And also we need to look at the distribution factor, like how is my money being distributed back to me that I've built up the most effective way? And that's where annuities are very, very powerful. But I hope you got value from today's video. Go to the top of the description. You'll see a link to my calendar. You can book a call with me. We can go over all of this in further detail. And then next you'll see a recommended video at the end here. Click on that, watch that, and I'll see you there.